I want to put something in front of you that should send a chill through every bullion bank operating on Wall Street. What I'm about to show you is not guesswork, and it is not based on projections or assumptions. These figures come directly from official sources. Published data from the Chicago Mercantile Exchange, confirmed delivery records, and publicly available inventory reports. Once you see these numbers, and more importantly, once you understand what they imply, you all recognize that the Comex silver market is heading toward a mathematical dead end, a point where the exchange simply cannot meet its physical delivery commitments. Today is Monday, January 13th, 2026. Silver finished trading on Friday at $85.73 per ounce. That puts us less than $1 below the all-time high of $86.62, reached only days ago. But price action is not the real story. What truly matters is what has already occurred in the first 2 weeks of January. Something extraordinary has taken place. The Comex delivered 33.45 million ounces of physical silver against expiring contracts. That amount represents 26% of the entire officially reported registered inventory, delivered in a single week. Let me say that again, clearly. In just 7 days, more than 1/4 of all registered silver was delivered, and we are not even halfway through the month of January. Now consider what comes next. March, which is the largest silver delivery month of the entire year, is only 6 weeks away. The March contract currently shows open interest equivalent to 57 million ounces of silver. That is 4 times larger than the total reported registered inventory. The math simply does not add up. The Comex cannot deliver 500 million ounces of silver when it only reports holding 127 million ounces. And even that 127 million ounce figure is deeply misleading. Analysts who closely monitor warrant assignments and vault movements estimate that the quantity of truly available unencumbered silver sitting inside Comex vaults right now is closer to just 28 million ounces. Everything else has already been promised, claimed, or allocated to bullion banks and industrial users. So we are not dealing with 127 million ounces of available supply. We are dealing with roughly 28 million ounces available versus 57 million ounces demanded for March delivery. That creates a ratio of 18-1. 18 ounces demanded for every single ounce that is actually available. This is not a temporary squeeze. This is not speculation. This is a mathematical certainty of failure. Let me walk you through the data. Let me show you what happens when an exchange is no longer capable of delivering metal. And let me explain what you need to do in the next 6 weeks before the system reaches its breaking point. Before we go further, a quick note for viewers who want more than surface-level headlines. I've created a short educational resource called the Silver Insider Toolkit. It explains the structural warning signals that emerge inside the physical silver market ahead of major repricing events. Things like Comex inventory shifts, changes in the futures curve, delivery stress, and policy interventions. This is the same analytical framework I use to break down stories like this one, and it's available now through the link in the description. Now, before examining the numbers in detail, it's critical to understand what registered inventory actually means. The Comex silver market categorizes inventory into 2 buckets, eligible and registered. Eligible silver consists of metal stored in Comex-approved vaults that is not designated for delivery against futures contracts. The silver exists, but the owner has not made it available to the exchange. Think of it like a car parked in a lot. The car is real, but it is not for sale. Registered silver, on the other hand, is metal that has been explicitly designated as deliverable. The owner has informed the exchange that this silver can be used to satisfy expiring contracts. This is the inventory that is supposedly for sale. As of Friday, January 10th, the official CME warehouse report showed total Comex silver inventory of 474 million ounces. At first glance, that sounds substantial. But out of that total, only 127 million ounces were classified as registered. The remaining 347 million ounces were eligible, and therefore not available for delivery. That means our focus immediately narrows from 474 million down to 127 million ounces, because only registered silver can actually be delivered. But this is where the situation becomes far more complicated. Just because silver is labeled as registered does not mean it is truly available. A large portion of registered silver is already spoken for. Bullion banks hold warrants against it. Industrial users have contractual claims on it. It may be registered in a technical sense, but in practical terms, it is not free and clear. This is why analysts, such as David Jensen and others who closely track Comex data, distinguish between reported registered inventory and effective registered inventory. Effective registered silver refers to metal that is genuinely unclaimed, unallocated, and available for immediate delivery. Based on warrant activity, vault transfers, and delivery patterns, multiple independent analysts estimate that the effective registered inventory right now is approximately 28 million ounces. That figure cannot be proven with absolute certainty because the Comex does not publicly disclose warrant ownership details. However, we can infer it from delivery behavior. If 33.45 million ounces were delivered during the first week of January, but the reported registered inventory declined by only 18 million ounces during that same period, then the remaining 15 million ounces had to come from silver that was already allocated, or technically registered but not truly available. That silver was counted as available until the exact moment it left the vault. In reality, it had already been claimed. This accounting practice is why effective registered inventory is dramatically lower than the headline number. The exchange is effectively playing a shell game with inventory reporting, counting ounces that are already encumbered as if they were freely available. This distinction becomes critically important when we look ahead to March. If the true available supply is 28 million ounces rather than 127 million, then March delivery demand does not exceed supply by 4 times. It exceeds it by 18 times. That is the breaking point. That is where the math collapses. Now, let's look at the January delivery data, because this is where the warning signs become impossible to ignore. January is not a major delivery month for silver. Historically, deliveries are modest. The heavy delivery months are March, May, July, September, and December. January is typically quiet, and yet during just the first week of January, the Comex delivered 6,690 contracts. Each silver contract represents 5,000 ounces, which means 33.45 million ounces were delivered between January 2nd and January 9th alone. For context, the entire month of December 2025 saw total deliveries of approximately 41 million ounces. In just 7 days, January delivered 81% of December's full month total. The delivery pace is accelerating, and this is happening during a non-major delivery month. So why is January seeing such intense delivery demand? Because the participants standing for delivery no longer trust that the metal will be available in March. They are taking physical possession now while they still can. This is front-running the shortage. Smart money, industrial consumers, and bullion banks covering short positions are all demanding delivery early because they understand that by March, available supply could be exhausted. This behavior is a clear signal. When record deliveries occur in a traditionally quiet month, it means confidence in future supply has broken down. Now, let's examine what happens to inventory when 33 million ounces are delivered. According to CME Daily Warehouse reports, registered inventory stood at 145.2 million ounces on December 31st, 2025, the final trading day of the year. By January 9th, after the first week of deliveries, registered inventory had fallen to 127.1 million ounces, a decline of 18.1 million ounces. But here's the critical question. If 33.45 million ounces were delivered, why did registered inventory fall by only 18 million? Where did the remaining 15.45 million ounces come from? This is the smoking gun. Those ounces were sourced from silver that was either sitting in the eligible category or was technically registered but already allocated. When delivery occurred, that silver moved directly out of the vault without ever being part of the truly free-floating supply. The exchange counts it as available until the instant it is delivered, but in reality, it was never available at all. This is how the shell game operates. The registered number appears more stable than it actually is, even as real supply drains away. In truth, available inventory declined by the full 33 million ounces, not just the reported 18 million. This is why analysts believe effective registered inventory has now fallen to roughly 28 million ounces. Once you strip out all allocated and claimed metal and look only at silver that is truly free and clear, the remaining supply is shockingly small. Now let's look at the daily withdrawal data to confirm that the drain is real. On January 7th alone, Comex vaults reported withdrawals totaling 3.25 million ounces, the largest single-day withdrawal in over a year. That silver went to multiple destinations: industrial users, private buyers taking delivery, and arbitrage traders shipping metal to Shanghai and Dubai, where physical silver is trading at premiums of $8 to $15 over the Comex paper price. We'll discuss the Shanghai premium shortly, but the key takeaway is this: the vaults are bleeding, and that bleeding accelerated sharply during the first 2 weeks of January. From January 2nd through January 10th, total withdrawals across all Comex depositories exceeded 41 million ounces. That represents net outflows of 41 million ounces in just 9 days. The current withdrawal pace is 4.5 million ounces per day. If this trend continues, the registered inventory category could be entirely depleted by mid-February. Will this pace persist? Maybe yes, maybe no. Delivery demand fluctuates, but the trend is unmistakable. Silver is flowing in one direction, out of the Comex system, not in. As long as this dynamic continues, the breaking point draws closer every single day. Now let's turn to the March cliff, the real crunch. The March 2026 silver contract represents the next major delivery month. As of Friday, January 10th, Open interest in the March contract stood at 101,187 contracts. Open interest refers to the total number of contracts that remain open, meaning they have neither been closed nor delivered. Each contract represents 5,000 ounces of silver. Multiplying 101,487 by 5,000 gives a total of 57.435 million ounces, the notional silver represented by these open contracts. Of course, not all of that open interest will result in physical delivery. Most futures traders close their positions before expiration. They are speculating on price rather than taking possession of metal. Under normal market conditions, perhaps 5 to 10% of open interest actually stands for delivery. 5% standing would equal 5,074 contracts, or 25.37 million ounces. That would be manageable. Comex could deliver that out of the current registered inventory. But we are not in a normal market. We are facing a shortage, a squeeze. And when market participants sense scarcity, they increasingly stand for delivery. Look at January. A traditionally quiet month saw 6,690 contracts standing for delivery. So if a non-major month saw that level, what might March, a major delivery month, experience? 10% standing would equal 10,148 contracts, or 50.74 million ounces. 15% would be 76.11 million ounces. 20%? 11.48 million ounces. That is precisely where the math collapses. Let's break it down with scenario analysis. Scenario 1, normal behavior. 5% of March open interest stands, requiring 25.37 million ounces. Effective registered inventory is 28 million ounces. Comex barely scrapes through, fulfilling obligations, with registered inventory approaching zero. March closes without incident, but then May arrives, with another 70,000 in open interest. If 5% stands, that demands 17.5 million ounces. But registered inventory is already depleted. Delivery failure occurs in May. Scenario 2, moderate squeeze, 10% of March stands, equating to 50.74 million ounces demanded. With only 28 million effective registered, Comex is short 22.74 million ounces. They cannot meet delivery without either paying a premium to convert eligible inventory into registered or invoking force majeure to cash settle contracts. Scenario 3, severe squeeze. 20% of March stands, totaling 101.48 million ounces demanded. Even using the full reported registered inventory of 127 million ounces, they are cutting it dangerously close. Any additional drawdowns in February in Comex is in deficit. Considering effective registered inventory is just 28 million ounces, they are short 73.48 million ounces. Catastrophic. Force majeure becomes inevitable. So where are we now? January's record deliveries in a non-major month suggest we are somewhere between scenario 2 and 3. Comex is clearly aware of the squeeze. Before diving into the Shanghai premium and its significance, it's crucial to understand why this matters to you. If you own or are considering buying silver, the Comex, Western markets, primary price discovery mechanism is nearing a point where it cannot fulfill its essential function, delivering physical metal against contracts. When the exchange defaults or invokes force majeure, it dramatically impacts price, market structure, and your ability to buy or sell silver. This is practical, not theoretical. To track this in real time, subscribe to this channel and turn on notifications. Over the next 6 weeks leading to the March delivery period, I will provide weekly updates on registered inventory, delivery notices, and withdrawal rates. This will allow you to monitor whether we are trending towards scenario 1, 2, or 3 and make informed decisions. Now, let's examine the Shanghai premium. Silver trades at $85.73 on Comex in New York, the paper futures price. In Shanghai, physical silver commands a significant premium. Sources including data aggregators and bullion dealers report physical silver in Shanghai currently trading between $93 and $100 per ounce. Using a conservative midpoint of $96, that is a $10-12 premium over Comex. In Dubai, similar premiums of $95, $100 are observed. Why such a premium? Physical silver is scarce in Asia. Chinese industrial demand is enormous, driven by solar panel production, EV batteries, and electronics manufacturing. China requires actual metal, not paper contracts, and they are willing to pay. Here, who has why this matters. If Comex silver drops to $80 while Shanghai remains at $96, arbitrage opportunities arise, $16 per ounce, a roughly 20% instant return for traders who can buy Comex, take delivery, and ship to Shanghai. Every arbitrager would do it, draining Comex vaults in days. This is why the Shanghai premium acts as a floor under the Comex price. The exchange cannot let the paper price fall significantly below Shanghai without triggering outflows. We see this in the withdrawal data. 3.25 million ounces left Comex vaults on January 7th, much of it arbitrage metal heading east. JP Morgan's New York Depository alone saw 1.1 million ounces withdrawn that day, likely destined for Shanghai. Buying at $85, shipping, selling at $96, $11 per ounce risk-free. As long as this premium exists, the flow continues, reducing March delivery supply. Finally, margin hikes illustrate Comex desperation. On January 7th, CME increased initial margin for silver futures from $22,000 to $3,250 per contract, a 47% rise. This is the cash required to open or maintain one contract. Hold 10 contracts? Officially, the hike is risk management, but consider timing. Silver was $72 on December 20th with 22K margins, $81 by December 30th with 28K, and $85 by January 6th, triggering $32,500 margins on January 7th. Every major price rally triggers a margin hike, not to manage risk, but to slow momentum by making long positions more expensive. Leverage longs are forced out, producing temporary price dips. After January 7th, silver dropped intraday from $85.70 to $83.20, a $2.50 dip. Yet by Friday, it returned to $85.73. The margin hike didn't halt the rally. It only added volatility to the market. But the hike itself reveals a lot about the state of silver trading. Exchanges raise margins when they are concerned about the solvency of clearing members, the large banks and brokers who guarantee all trades. If a trader defaults, the clearing member is responsible. So when the CME sees clearing members holding significant short positions facing mounting losses, it hikes margins to force traders to post more cash, reducing default risk. Who holds these large short positions in silver? The bullion banks, JP Morgan, HSBC, and others. These banks are historically short silver as part of market making and hedging strategies. As silver prices rise, their losses increase. When those losses reach uncomfortable levels, the CME can see it and responds with higher margins to slow the rally and give the shorts some breathing room. The 47% margin increase on January 7th is a clear signal. The shorts are under serious pressure, real pressure, enough that the exchange intervened. And if one 47% hike wasn't enough to halt the rally, what happens next? Another hike, possibly to $45,000 or $50,000 per contract, if silver pushes above $90. Eventually, margins could rise high enough to price retail traders out entirely, leaving only institutions. In an illiquid market like that, prices can swing violently. That is when things become truly dangerous. Now let's look at what happens if the Comex cannot deliver physical silver. This is not theoretical. There is a mechanism for it, called force majeure. Force majeure is a legal clause that excuses a party from fulfilling contractual obligations due to extraordinary circumstances beyond their control. Acts of God, wars, natural disasters, or, relevant here, an inability to source the underlying commodity. If the Comex reaches a point where demand for physical delivery exceeds available registered inventory, they can invoke force majeure. This means they declare they cannot deliver silver and instead cash settle the contracts. For example, if you're long the March contract expecting 5,000 ounces of silver and the Comex invokes force majeure, you don't get the metal, you get cash. The exchange decides the settlement price, which may not match the market. History shows the precedent. In 2022, the LME nickel halt saw trades above $50,000 per ton retroactively canceled. In 2001, NYMEX, now part of CME, invoked force majeure in palladium when Russia, the largest supplier, stopped exports. Traders expecting palladium received cash instead of metal. The mechanism exists, and with March demand possibly exceeding 100 million ounces, while only 28 million are effectively available, force majeure is a very real option. Some might worry that declaring force majeure would crash prices. Not necessarily. In fact, it could boost the physical price. It signals a genuine shortage. The primary Western exchange cannot supply silver. Paper prices may dip temporarily as futures traders react, but physical premiums will soar. Shanghai, Dubai, and other spot markets will bid aggressively for limited metal, creating a bifurcation. Paper trades at $80, while physical trades at $100. If you own physical, you benefit. Here's a potential timeline, based on current data. We are mid-January. Effective registered inventory is 28 million ounces. If another 20 to 30 million ounces are delivered before month end, registered could reach near zero by February 1st. 5 weeks later, March delivery begins. The Comex must rebuild inventory, likely by offering premiums to holders of eligible silver to convert it to registered. Some holders may comply, but many industrial users or bullion banks will prefer higher premiums elsewhere, like Shanghai, leaving the Comex short. Assume the Comex manages to bring registered to 40-50 million ounces. March arrives. First notice day is February 26th. If 10,000 contracts stand, that equals 50 million ounces. On paper, delivery is possible, but withdrawals continue. The Shanghai premium persists, and arbitrage flows drain 10-15 million more ounces during the month. By mid-March, registered could fall to 30 million, still needing to satisfy remaining delivery obligations. Comex scrapes by, but May looms. With 70,000 contracts open, 25 million ounces may demand delivery. Registered is now zero. Force majeure is triggered. Cash settlement occurs and the market reacts violently. What happens when force majeure is declared? Multiple things occur at once. Paper price drops. Futures traders expecting delivery receive cash instead, selling in frustration. The Comex price may fall 10 to 15%. Physical premiums explode. Owners of physical bars or coins see value surge. American Silver Eagles, currently 35% over spot, could jump to 50-60%. 1,000-ounce bars could move from 5% to 15-20% above spot. The physical market decouples completely. Shanghai premium widens. If Shanghai was $96 and Comex drops to $75, Chinese buyers still need metal, widening the east-west spread from $10 to $20. Lawsuits. Longs expecting delivery will sue the Comex, possibly in class actions. These cases take years. Regulatory scrutiny. CFTC, SEC, Congress, all investigate. The media and political fallout will be intense. By the end, the Comex loses credibility as a physical delivery market. Silver trades in a two-tier system, paper versus physical, with physical at a permanent premium. So, what should you do? Futures holders planning to stand for delivery in March. Recognize force majeure risk. You might not get metal. Take delivery early, if possible, in February. Physical silver owners, hold. Don't sell due to paper market volatility. Your metal will gain value if the Comex fails. New buyers, focus on physical, despite high premiums. Paying 35% over now is cheaper than potentially 60% over later. Mining stocks. Large, low-cost producers in safe jurisdictions will benefit if silver jumps to $100 or $120. Avoid juniors with high costs or political risk. Stay informed. Track Comex warehouse reports, delivery notices, and the Shanghai premium. Data reveals which scenario 1, 2, or 3 is unfolding. To summarize, in the first week of January, the Comex delivered 33.45 million ounces, 26% of reported registered inventory. Effective registered inventory is down to 28 million ounces. March open interest represents 57 million ounces, 4 times the reported registered, 18 times the effective registered. If even 10% of March stands, Comex is short. At 20%, they're catastrophically short. The Shanghai premium and January's 47% margin hike confirm shorts are in pain. All data points to one conclusion. Comex is nearing a breaking point. Force majeure is likely. Cash settlements, paper physical bifurcation, lawsuits, investigations, and market restructuring are imminent. This is not speculation. This is math. Public data confirms it. March is 6 weeks away. First notice day is February 26th, 44 days. In 44 days, we will know if the Comex can deliver. Position accordingly. Acquire physical now, consider early delivery, and recognize the window to buy at reasonable premiums is closing. Once force majeure is declared, premiums explode and availability vanishes. For an institutional framework and educational insight into these dynamics, see the Silver Insider Toolkit linked below. It shows how to read the silver market beyond the charts.